need a quick refresher on taxation principles, you've come to the right place. Welcome to another episode of the Functioning Law Podcast, offering a quick introduction to what you need to know about taxation, presented through a case study prepared by Dr. Yannis. I'm Theo, and I'm joined by Anna, who is preparing for the SQE.
Thank you, Theo. I'm glad we're doing this. Tax always feels like a big tangle. If it helps with revision, I'm in.
We're going to explain the main features of UK tax by following Annabelle and Conrad, who are trying to scale up their business. They've invented a novel door ring camera. After building a few prototypes in Annabelle's workshop, they now want to start selling them.
So they're at the very beginning, trying to figure out how to turn an idea into a company?
Exactly. And they're thinking about the best way to build that business, especially the tax implications of different forms of business organization.
This is something that a lot of people will want to know about, both SQE candidates and entrepreneurs.
Let's get started. We'll focus on elements of personal and corporate taxation in the UK. We'll explain how different business structures affect tax liability and walk Annabelle and Conrad through their implications. Tax liability is one of the key elements when deciding how to organize a business. Different structures can lead to very different tax outcomes, so optimizing your setup for tax purposes is going to be front and center when creating a business or investing in the UK. In the UK, the main provisions of income tax are set out in the Income Tax Act 2007.
And what's the basic rule?
Everyone with income from business, employment, or investment pays tax on their total taxable income each year. That's income minus any allowances, deductions, and reliefs. HMRC determines what qualifies. Remember, the UK tax year runs from April to April, not January to December.
Got it. What counts as income?
Annabelle and Conrad might earn income from salaries, from trading as inventors, or from things like interest on deposits, dividends, and rental income from property. If your only income is from employment, HMRC calculates your liability automatically based on what your employer reports, and tax is deducted at source. That's the PAYE system, pay as you earn. So what hits your bank account each month has already been taxed and had pension and national insurance contributions taken off.
But if they earn anything extra, say from a side hustle or dividends,
Then it needs to be declared to HMRC. That can be done by updating your PAYE code or, more commonly, through a tax return at the end of the year. If HMRC finds that more tax is due, it's either paid directly or added to next year's PAYE code. But not all income is taxable. For example, if Annabelle earns £50,000 but pays £6,000 into her pension, only £44,000 is taxable.
So pensions can reduce what gets taxed?
Exactly. Most private pensions, including workplace, personal, stakeholder, and some overseas schemes, qualify for UK tax relief. Tax rates are set in the budget every year. For example, in 2022 to 2023, people with taxable income below £125,140 had a personal allowance of £12,570 tax-free. Then there's a basic rate of 20% on income between $12,571 and $50,270. Higher rates follow after that.
Just to be clear, if my income is, say, $55,000, I'm not taxed 40% on all of it.
No, that's a common misconception. You only pay higher rates on the portion that falls into that band. The UK income tax system is progressive. Higher earners pay a larger share. That's the opposite of VAT, which is a flat 20% on most goods and services and affects everyone equally, regardless of income.
So how does this apply to Annabelle and Conrad's business?
It depends on how they structure it. They can operate as sole traders, a partnership, or incorporate as a company. Sole traders and partnerships are taxed as individuals. Their business income isn't separate from their personal finances.
And in a partnership?
HMRC treats the partners as a group of individuals. The partnership itself isn't taxed as a separate person. Now, only profits are taxed, and to calculate profit, you subtract business expenses from trading income. But not all receipts are trading income. Capital receipts, like from selling fixed assets, are treated differently.
And those get taxed as capital gains?
Yes, and the rates differ. For example, if you sell residential property, you may pay 18% or 28% depending on your income level. If the gain qualifies for business asset disposal relief, like selling the business itself, the rate can be as low as 10%.
How do they know what counts as a business expense?
Expenses must not be capital in nature and must be wholly for the business. Think rent, staff salaries, stock, advertising, utility bills, office equipment. Keeping accurate records each year is essential, especially if they want to claim tax reliefs.
And if they lose money?
Then no taxes due, and losses can be offset against profits from the same or previous years. There are also extra allowances for new businesses, especially in their early years.
Okay, what if they incorporate?
That changes things. The company becomes its own legal person and pays corporation tax on its profits. The main legislation is the Corporation Tax Acts of 2009 and 2010. Taxable profits include both trading income and capital gains, minus any reliefs. Listeners should have a look at Episode 2 in our Functioning Law podcast, where we discuss the steps one needs to take to incorporate a business.
Good idea. I had almost forgotten about that. So, what's the current rate of corporate tax?
Since April 2023, it's 25% for companies with profits over £250,000, and a 19% rate applies to those with profits up to £50,000, and marginal relief exists in between. Tax is usually due 9 months after the end of the company's financial year.
And how do they take money out of the company?
Through salaries, dividends, or both. Salaries are deductible for the company and taxable as income for Annabelle and Conrad. Dividends are not deductible and are taxed separately on the individuals.
Are dividends better, tax-wise?
It depends. In 2022, the first £2,000 of dividends were tax-free. After that, the rates were 8.75%, 33.75%, and 39.35%, depending on total income. But remember, dividends don't reduce the company's tax bill.
What about benefits in kind?
They're taxable. Say Anacon Limited pays £8,000 rent for a flat Annabelle uses, but she only contributes £4,000, she gets a taxable benefit of £4,000. Also, any expense allowances not used for work become taxable income.
Couldn't they just hire themselves as contractors to avoid PAYE?
That's risky. HMRC's IR35 rules target that. If they treat themselves as contractors but actually work like employees, HMRC can impose PAYE, national insurance, and penalties. Plus, they'd lose employment rights.
And if they move abroad?
If they live in France but do business in the UK, they'll still pay UK tax on UK income. Even if they're not UK tax resident, they might need to file returns if they receive income as directors, earn rent, or sell UK property.
So can they pick which country to pay tax in?
Not really. You can't double dip on allowances. You either claim UK reliefs or French ones. The UK-France tax treaty prevents double taxation. For example, the UK won't tax income earned by a French resident unless there's a permanent establishment here.
And the same goes the other way?
Yes, if they're UK residents working in France for under 183 days and their income is taxed in the UK, France won't tax it.
What about international businesses like Apple and Amazon? How do they handle tax?
That's where OECD's Base Erosion and Profit Shifting, or BEPS, comes in. Countries are working together to close loopholes. There are now common rules to prevent treaty abuse, force companies to report where they earn and pay profits, and make dispute resolution easier.
And what's this about hybrid mismatches?
Those involve differences in how countries treat income or entities, like a payment that's deductible in one country but not taxed in another. OECD countries are tightening up. Some of these standards are now considered soft law, but they still guide national policies.
Let's talk about payments. How does money move?
Payments can be made by cash, check, or more commonly, electronic transfers. In the UK, we use CHAPS for high-value payments, BACS for salaries and bills, and faster payments for instant transfers. For international payments, SWIFT is standard, and for euros, SEPA and Target 2 apply.
Is there risk?
Yes, if a bank in the payment chain fails, transfers can get stuck. To reduce that, settlement rules now include monitoring, credit limits, and sometimes real-time gross settlement. In insolvency, only debts between the same parties can be set off.
And that's where clearinghouses come in.
Exactly. They manage the process of exchanging payment instructions. In the UK, clearing banks operate under the Association for Payment Clearing Services. They ensure that money moves securely between accounts and across borders.
And money laundering?
Covered under the Proceeds of Crime Act 2002 and the 2017 regulations. It's a crime to conceal, transfer, use, or possess criminal property. The definition includes anything gained through crime, including tax evasion. Regulated professionals must report suspicious activity, and failure to do so can lead to up to 5 years in prison.
Even if someone didn't know for sure?
Yes. If you should have known, that can be enough for liability. The test is objective, especially in regulated sectors like banking and investment.
Okay, that was a deep dive.
In this podcast, we covered UK income tax, corporation tax, business structures, international tax corporation, payments, and anti-money laundering rules.
And for anyone listening, subscribe to Dr. Yannis's MCQ SQE newsletter, the YouTube channel, and hit like to support this project. We've got more to come.
Thank you for listening. Until next time.